You can see my screen and everything, right? Okay. Okay, this is a Ed Yardini research. He's a pretty good economist, and a lot of smart people follow him. He put out this note this week about 10-year Treasury versus the S&P forward earnings. So you can see that the S&P right now is trading around 16 or 17 PE. That's this spot right here. And this is the yield of the 10-year Treasury. So you can see it's an inverse correlation. So we've been saying it for at least a couple months now that, as the yields go up, the price, the premium that investors are willing to pay for the stocks in the S&P goes down. So it's like a total inverse correlation. You can see back in the 80s when the S&P, whenever let's see, what is this is 10-year Treasury yield. Whenever it was up 26, that's probably the highest on record. The amount that people were willing to pay for the price to earnings ratio of the S&P was down to 6 or 7. So whenever you're investing, you got to think of at any point in time, you might have quality companies, but the amount that people are willing to pay for a premium for those earnings goes down as interest rates go up. And that's primarily because you have an alternative. If you get 26% interest in 1981, who's going to want to take, that's a short thing, who's going to take a risk in the stock market? That's basically what's happening. So now we're seeing, as the yields rise, you have alternatives to the stock market. And right now, we'll just keep our eyes on this and review it every now and then to keep in sync with which way. It seems like we're still rising. We're going to go above 4, maybe to 5. So the earnings ratio people are willing to pay is probably going to go down to 14 if we're following this graph. So yeah, that's the first thing to bring up. Let's look at the S&P. It's up today. Let's go to my meeting notes. Meeting notes. One thing that happened this past Friday, we've been waiting for some kind of definitive Fed statements. And the Fed said Friday they started some kind of they stated some things that hinted that they would raise maybe 75 basis points at the next meeting and then pause. And look around to make sure that the economy is not doing too bad. So this hint that they were going to pause caused the dollar to go down, the rates to go down, gold and silver up, and the markets to go up. So that's exactly what we expect to happen whenever the Fed says we're not going to raise rates anymore. Oh man. Okay. Okay. So I think that was a decent. It wasn't a pivot. People are saying it's a pivot, but it was an indication that they might at least pause instead of continue to raise rates. So let me see. Let's look at some of our the calendar here. We were expecting this week to be a positive week because of the earnings. This is the time that so far the stocks, the earnings reports have been good and better than expected, or worse, better than feared. And we have Google, Meta, Apple, Amazon, big tech earnings coming out in the next couple of days. And if they do better than expected, there's a chance we could, at least for the individual stocks, to blow out of their downward trend. We'll just have to wait and see what happens. But we're at a point right now where we're almost in the S&P. We're getting to a point where we're almost overbought. We're at 70, in the stochastics. So it's and we're looking at our stochastics charts for the S&P. There we go. You can see that we're still in a downtrend. We're still making lower highs, lower lows on the year. We're halfway, like right in the middle of, this downward channel. If we go up a little bit more, we'll hit the top of the channel, maybe at the end of this week. We either go back down in a lower highs, lower lows, or we break out of this. And the things that can make us break out of that are earnings and the Fed's done raising interest rates. So let's see what happens there. Let's look at our what are the things we have to look forward to. We have the Fed meeting. That's going to happen next week. So next week we have they're going to raise the rates like 75 basis points, and probably maybe in the next Fed meeting they'll raise them again. Then they'll be done maybe. So we have all kind of numbers, economic numbers coming out on the 4th and the 10th, and that can move the markets one way or the other. So November is traditionally a good month, and so is December. So when we have the holidays of Thanksgiving, Christmas, and New Year's. So those are all three big holidays. People are happy around then, and a lot of times they have good performance around those holidays in the stock market. And then we have tech earnings again in January. So that's why January is considered a good month also, because you also have the best earnings of the year in December, because Christmas sales are they're high for companies like Apple, and Apple reports their earnings at the end of January. So then we're back into February. February is just a no earnings month. Nothing really to get excited about, and it's usually one of the worst months of the year. And then March is probably a better month. So just looking at that and seeing where we are right now in the S&P, let's look. Okay, so we're in a downtrend here, and until further notice, we're going to be hitting lower highs and lower lows until we get the break in earnings and a break in interest rates. Any questions about that? Right. Let's look at our big chart. We like to look at things that can make the market go up and down. There's a big problem with China right now. It seems like their economic environment is kind of is in turmoil because they have a zero COVID policy. They're kind of closing down their economy. There's dissent. There's people that are dissenting against the leader, and the stock markets in China are kind of unstable right now. That reminds us of how we saw the Alibaba investment, is pretty unstable and it's uninvestable. Whenever you have too many unknowns, it's better to call it a loss and move on than continue this unknown. And right now, I think all the China stocks that are listed in America are down 20% today, because the leader of China said he's going to be the leader for a couple more years. So that's not so good for China related stocks. Right. So let's look at some of the good things. Again, go ahead.
China, the statistics, the government delayed GDP report until after the Congress. The party Congress, and they say they grew by 3.9% this year. We'll see.
Yeah, but it's interesting. You can't trust anything.
I don't trust that number. Yeah, I don't trust that number. No.
So, and then China said that they're not going to be providing certain government GDP statistics, and you don't know who to trust. And the problem is that the people in China are so on the edge right now. They don't like the leader, and they don't like being locked down. And then on top of that, if you have a slowing economy and the economy's not doing good, and they report that, then I don't know. It's just a pretty unstable situation. And what you'll see from the stocks going up and down today, the ones going down the most are involved in China in a big way. Let's look at that just for kicks. The stocks that are going down the most, Las Vegas Sands. Now, this company is called Las Vegas Sands, but they have no exposure to Las Vegas anymore. All their growth is in Macau, in China. So anything that's like heavily levered to China, like Starbucks is, they have sales in China. I mean, they expect a certain amount of growth in China. Wynn Resorts, the same thing. Their Macau in China is like one of their biggest growth potentials. And so Tesla, they said that they're they're lowering prices of their vehicles in China. So a lot of these are just China stories here. And let me see, what is Yum? Yum is a big presence in China there, like Taco Bell, KFC. But let's look at the ones that are doing good. The ones that are doing good. Okay, let's go back to our theme. Stocks that do good in this environment. Healthcare, because people have healthcare regardless of the price. And you have Dollar Tree. You have people that are price conscious in a recession, so people will trade down from Walmart maybe to dollar stores. The Kraft Heinz, food stocks. So people are going to be buying food regardless, and they have pricing power. So that goes back to our game plan. Companies that can raise prices, the companies that have profits now, doing great in this. Listen, they cut it short. But we were focusing on the drug stocks this year, the stocks that pay a dividend, stocks that people buy their products regardless of how much they cost, and they have pricing power. All right, so the ones that are going up the most today, healthcare, Tractor Supply, something we're following. Key Corp, these are banks. And Alaska, there. So there are some indications that there's a high demand for air right now, air travel. And a lot of the airlines are doing good because of that. Let's look at the NASDAQ, see which ones are going up and down the most. Drug stocks. Half of these are three-fourths of the ones going up the most are drug stocks. A lot of these stocks got upgraded, like Eli Lilly had an upgrade today, and I think that goes back to our theme of this year. The drug stocks are low PEs, and they have a high dividend, and they have consistent demand in bad times. The ones that are going down the most are all China-related, mostly China-related. JD.com, Baidu, stocks that are heavily levered to China. All right. So that was a good review of what's going on up and down in the market today. Let me see. Okay, so we didn't have anything affecting any of these topics. If any one of these resolved itself, like the Russia and Ukraine war or the China signal, none of these COVID lockdown is not ending for China. Inflation's not getting better yet. Okay, catalyst for market going down. We had the 10-year, 2-year and 10-year going up. And we had a problem with geopolitical tension with China. It's kind of an unstable environment. So that could be the catalyst for the market to go down. All right. What we're going to do is we're going to look at what else is happening? Okay. We'll look at the price of the major variables affecting stocks. Crude oil, it's down 3%. In a bad recessionary environment, the more hints that we get that there's going to be a recession, and let's say Jamie Dimon says 100% chance of recession, price of oil is going to go down. So, if you're investing in oil stocks, you have to be willing to take. For the price of oil to go down with a recession. Let me see. 10-year Treasury is up this week. Usually that's an indication that the stock market's going to go down, but last week we actually went up 5%. So you see that 2-year Treasury, it's up 1% since last week, and there's no inflationary changes, and the U.S. dollar is going down. It's starting to go down. So as the Fed stops raising the rates, the dollar's index is going to go down, and that'll help multinational companies because that makes the amount that they make from overseas greater. All right, let's look at what's going up in the stock market. Let me see. And the sectors. What do we expect today? Okay, energy. Let's look at this is the pre-markets page. This tells you where the stock market's going before the beginning of the day. It also tells you the price of crude is down. So we expected the oil companies to be down today. That's interesting. Let's look at the oil, the energy stocks are up today a little bit. Ones down the most are materials. Interesting. Right, so materials are down, real estate, and mining, consumer discretionary. Okay, and the ones that are up the most, healthcare, regional banking, banking, oil, home construction. Okay, so we have a lot of contrary new people predicting things on. I'm going to show you a couple of the most recent. Okay, on Friday the Fed hinted that they would pause during their notes, and so as soon as that happens, the stock market's going to go up. If they say they're stopping and they've reached a time when they're going to stop raising rates. So, there's some talk about this Fed pivot, and every other time that there was a Fed pivot talk that's been sold off, we're excited, and then it was sold off. So we're just looking at the S&P 500 right now. It's still in a downtrend. Even if we get up to here, until it breaks out of this channel, don't trust it. It'll probably go back down to here because people are excited about a Fed pivot, and then they'll raise the rates, and then we'll go back down. But we are towards the end of the year, and that's good for seasonality. All right, so as you can see, I'm tracking two different channels. One is this short-term channel. We're at the top of that as of today, and let's hope we don't go down to here, because then we've broken out of this long-term downtrend. It's lasted all year. But we're almost at the point where we're overbought. As soon as we're overbought, then we run out and we go down to the next lower low if we don't have something to break us out of that. Dollar index is basically down a little bit from last week, and that's good for stocks. So we have to always keep track of this dollar index. And we're keeping track of this also. These are the major levels of the S&P. We're holding right around this 366 level. Right now, the S&P is at, let's look at where we're at in the S&P. 376. Okay. So this 366 level is 366 is kind of long-term support. You can see it goes back a long time. So until further notice, these are good support for the stock market. And if we have a sell-off, for whatever reason, these are our circuit breakers. These are the times when the stock market will stop, pause, and then we'll go back down to this level. And if We'll stop, pause, then we'll go down to the COVID low number. But let's see if that ever happens. We don't know. U.S. Treasuries, 2-year and 10-year, are both up 6% and 1%. 2 years, 1% since last week. That's usually bad for stocks, but the stock market actually rallied last week 5%. Fear and greed index. People are feeling a little better now. We have a lot of cash on the sidelines, and there's the natural tendency for people is to fear of missing out. So usually whenever you have extreme fear, people sell. Fear, people are just kind of cautious. And then neutral, people are like, oh man, I might miss out of this. And then they start getting greedy and they start buying. And by that time, the market sells off and they get into extreme fear again. So you have to do contrary to what everyone else is doing. And right now, people are they're not buying protection. They're feeling comfortable with the market. And you see, all right. So the VIX is at 30, and that's still a certain level of fear. When it gets back down to 15 to 20, that's when we know that people aren't afraid anymore and they're getting more greedy. Right? So the S&P, we're just keeping track. We're overbought right now. We're at like 70 out of 100 in our stochastics. So as soon as it gets up to here, we know we're overbought. And whenever we have a major sell-off like this, I mean, this is down 30% this year for major indexes. And whenever we're in a position where there's a short covering rally, you can just throw all the stochastics out the window, and people are just like, oh, I got to get in. Whenever the Fed says, let's say today, the Fed says we're done raising rates, we're actually going to start going the other way. We're reducing rates. If that ever happened, we have to none of the stochastics work. This only works whenever we're in a sideways market. And it seems like this chart that Ed Yardini had about S&P, averages over time with the yield, that's going to be really important to watch every week because we're going to be in a time again when the S&P is trading, maybe at a high or a low, and then we have the rates down to zero again. Whenever that happens, we'll be ready, and know it's going to be a good time to buy stocks. All right. So continuing to watch this, whenever the Fed reduces the amount of liquidity in the system, stock markets drop. And, we'll be ready the next time the Fed starts reducing interest rates and adding money to the system. We just have to keep in mind how important this is to the amount people are willing to pay for stocks. This is the federal funds rate versus the S&P. Not the S&P price to earnings ratio. It's just you see the correlation to that also. So let's look at. We always like to look at how the past drawdowns in the stock market. 86% in 1929, and almost every single time that you had this 30%, 50%, 30%. Now we're at 28%. Whatever it was done, the low was made. Look how it came up in the next couple months. So it seems like the reason this happens, you have people that are positioned to be short, and whenever something changes, people have to cover their shorts, and that makes a super reversal in a short amount of time. And it actually took a little extra while in 1930s to get back up, but recently it's been down 35%, up 35%, and I don't know, that's just a pattern. You got to be willing to buy in a market that's down in order to achieve the gains of 30% in the year. If this pattern continues, we'll see. The Any questions about any of this? Right. There's an article by Stanley Druckenmiller. He's a really smart hedge fund manager. He said the number one piece of advice for novice investors, and I highlighted what he said. He basically says that we can take an example of what he said here to the chip market from this year. So he had this. He said you always have to sort of imagine the world the way it's going to be 1 to 2 years from now as opposed to now. If you buy it now, you're buying every single fad in every single moment. Whereas if you envision the future, you're trying to imagine how that might be reflected differently in security prices. So earlier this year, we were saying, oh, there's going to be a high demand for chips because there's a shortage now. And so if you bought chip-related companies based on that thesis that, wow, there's a high demand now, the reality is that the chip companies overproduced, so there was a glut, and now they have a lot of inventory and they're selling off. So that's an example of what you have to look for is like what, from 1 to 2 years from now is going to happen. So if we look at our calendar, what could happen in the next 2 years, and let's say at the end of next year, the Fed will be done raising their interest rates. Maybe they'll be reducing them, and that'll make mortgages more available. So maybe home builders, might be, going up then. Or right now, you have inventory problems. You have problems with input to cars or whatever. When would that be resolved? So he says it's the stocks that are, selling off and that have temporary problems. You have to envision 2 years from now what's the world going to be like in 2 years? Like maybe the electrical vehicle stocks. They're losing money now, but the fact is that the government's funding this for global warming, and potentially that's going to be a new world for those kind of stocks in 2 years from now. All right, so okay, there was an article, 10 value stocks that are too cheap to ignore, and one of them was Qualcomm, and I think Qualcomm is an example of a stock that was thrown out with the bathwater. Like a lot of the chip companies have gone down like 80% or between 30 and 80% this year. And you mentioned it's undervalued. And I did some research on that just for kicks. The CFRA said its fair value is 278. So they said it was undervalued by 140%. So I said, well, let's research that just to see if if it has any potentials. Okay, right now it's trading at $115 a share. One of the biggest problems with Qualcomm, you can see it has heavy support right here around. Let me get that bottom here. Let's go right here. Okay, that's around $120 a share. Every time it hits 120, it has bounced in the past. So it has support around where it's at right now, going back 2 years. It went down as low as $63 in the pandemic. So it's a chip stock. It provides, I think one of their biggest customers is Apple. But they recently diversified into software. So they actually bought a software company, and they make almost half of their money on residual income from software. So although they went down with the SMH, let's look at them combined. It's the comparison with the SMH. That's the Bang Semiconductor ETF. It's like exactly the same, right? But they've diversified into software. So right now half their income is residual, and almost almost guaranteed, versus the chip sector, which they're going down with the glut of inventory with the chips. So what I did was I said, well, are the numbers there to warrant us looking at this? And you can see that they've had issues over time having consistent earnings. One of their biggest problems in the past has been they've had a hard time collecting royalties, and they've resolved some of that recently. But they're diversifying into like the Internet of Things. They're diversifying into, they have the chip business and virtual reality, things like that. So, but you can see they had a problem with consistency over time. And their PE ratio is pretty consistent over time, with what they've had a low PE, like every year they've had a high PE of like 20, low PE of like 13. And that's consistent. Now, if we see it trade down to like a PE of, let's look at these statistics now, just for fun. Okay, so the PE right now is 8. So that's a lot less than the typical amount that it trades for. So the PE high-low has been 13 has been the low, but now it's trading for almost half of the average PE, 14 over time. And so let's look at, okay, so the forward PE is 9. It says the PEG ratio is 51. So Yahoo Finance thinks it's growing its earnings around 16%. And our two numbers that we're following, this profit margin, that's better than the 13 we're normally looking for, and return on equity is 106. That is like 10 times greater than our target, our minimum. So this is like a really good, it seems like it has really good numbers. But the one thing I was disappointed with, the outlook for the company, it only goes out 1 year, according to this summary of estimates. It only goes out 1 year, and they're calculated to only grow at 2.5%. I don't know if that's a temporary thing, but I would want, before I invest in this company, I want to see like these 3 or 4 years out in advance how much they're going to be growing. I would expect, like Yahoo says, they're growing at 15 or 20%. I would like to see that in this chart here. But right now it says it's growing at 2.5%. That's not that great. So they're like, their fair value is like 34. They're only growing at 2.5%. But the unwritten theme here is that they're moving from hardware to recurring software company. Like Apple is trading at a premium because most of their revenues right now are from App Store and licensing and things that are not hardware oriented. So you get more of a valuation for having that kind of business model that's more reliable. So they're not getting a whole lot of respect right now with the analysts. They're not respected very well by the analysts, and they're not respected very much by the market. So, but they do have a monopoly in their 5G technologies. They have a monopoly in a couple key aspects of mobile interaction. That's a growth field. And there's Internet of Things. There's the possibility their chips are going to be in virtual reality sets. So that's the whole set of growth that's not worked into the company. But we have to check in on this every now and then just to see if these numbers are growing. Right now, it's not that exciting to me. But whenever you see an article that's like 10 value stocks that are too cheap to ignore, wow. But it is, the great thing about, I guess, this right now is it's been trading at a multiple of 13 its whole life, basically, almost. And it's like half of that right now. The valuation is half of that. So, and on top of that, CFRA thinks it's half undervalued, and Yahoo thinks it's half undervalued. So I guess we got to do our research to really figure out why that makes sense. I really like this E-Trade, the annual earnings estimates. If maybe we get a different way to look at that and see if they're growing 10 or 20% a year, that would help us really understand if this is worth buying. Is there any questions on that? Right. So an article came out today. Chinese markets tumble as President Xi tightens grip, alarms investors. So we flagged Alibaba as like speculative stock. I think it was like a year ago when China started making these capricious rules that, arbitrary rules that these China stocks had to follow, and it just made it an unfair environment. They started taxing Alibaba, taxing some of these big companies, saying that Didi couldn't have their app in the App Store. It just was so unfair. Now, this president has another couple years in office, and all these China stocks went down 20%, and it's just a good example of we're following a stock. It seemed like it was growing 20%, 15 to 20%. Whenever we get a red flag that we have a potential unfair environment, other red flags like that are if the company is sued, like Johnson & Johnson for talcum powder that could bankrupt the company, or something that, intangible that could hurt the company that we can't put our foot on, or finger on. So right now, the China situation, it just makes it totally uninvestable right now, and it's an example of bailing out of a stock when there's considerable uncertainty. So we're going to watch this just as a lesson learned, and so the China stock market is pretty much crashing right now, and the whole environment in China is unstable. So we have companies that we follow that are invested in China, like Starbucks, etc., that are going to be affected. Nike will be affected because they have a certain amount of growth in China. So we bring this up just because it's important. China is a big market for a lot of companies in America, and a lot of times activity in China, such as the COVID lockdown, really affects some of the sales that companies we're following. All right, any questions on that? Right. So I'm tracking our fear greed. You can see that we've gone past this extreme fear, and we're returning to the norm right now, returning to our mean. So we're not at this takeoff yet. As soon as we get the Fed saying that we're going to stop raising interest rates, then we have this takeoff, we have a first sell-off, and then get enthusiasm. That could happen in the middle of next year. But right now we're recovering from this huge sell-off. People are their fear of missing out, and then you have everyone on the TV saying, we have a 5-day rally. So we just have to keep that in check with our S&P chart, which basically is we're still in a downtrend. We've hit the top end of this downward channel today, and with earnings we'll probably go up to the top of this channel and probably resume this until the Fed stops raising interest rates. All right, let's look at
the left side of the bubble chart, the stock market chart, is valuation. But from what we've talked about, I guess in the past, valuations aren't super cheap right now. Still, right?
Right. Right now, if you look at the long-term average of people that the market has paid for the S&P, has been around 16, right? Between 14 and 16. I think it's like 14. So you can see that if we cut right in the middle here, it's been like the average. So we still have a ways to go before we go back down to the long-term average. But, it's all relative to what the earnings are going to be. And everyone on TV is saying this. They're saying Well, what if the average S&P stock grows only at 5% for the next year? Um, then what you have is the stocks of the S&P trade down to make maybe a 5 to be a fair value. But I guess this is a simplistic way to look at it. But one thing that skews the average, the S&P average, is the top 5 to 10 stocks are super overvalued now. And they're a big chunk of the S&P. Like they're 15% or more of the S&P. And Apple is trading at 25 PE or something. You have Amazon trading at 80% PE. So that's kind of affecting it too. I guess if you take out the top 15 stocks in the S&P, the S&P will be trading at like 13. That makes sense?
Mm-hmm. Yeah, I just, as I've said in the past, I don't do a lot of. The majority of my money is in individual trades. I do a lot of kind of index holding, but I think there is a real risk that we're going to be kind of trending sideways for quite a while on price, because it's not clear to me that earnings. Eventually see where earnings go. That will affect things. What the forward earnings are going to be, but you were on the chart. You were showing like, oh, we're past we went through capitulation and despair, and I'm not convinced that we've gone through capitulation and despair.
Oh yeah, well, if you look, I'm going by that fear greed index. We're back at neutral again.
Yeah.
So people think we're out of it, and then we go back to this. People think they get confident, they're greedy, and then there it is, the next spot down.
Yeah.
So,
yeah. So I think I have long-term valuation. It can lead into this too. That if we're kind of middly valued, I think there's a good chance that we could just kind of trend sideways for quite a while, price-wise.
Yeah, there are people also that compare this market. We do this because people say it on TV. But hold on for a second. People compare this market to 2008, and I mean, they put a chart next to each other, down to 2008. So if we look back to 2000, we can't just go back that far. Oh, right. Okay, so let's say this is 2008, and we're right here, right? And we think we recovered, everything's good, and then we just tank. So we might be going through something like that. Only because there's loss of liquidity, that the government's taken away everything, all of the punch bowl. And we might just go into that, but you got to be ready for it because it'll spike right back up, after it goes down.
Yeah, and I could be very wrong. It could spike back up. But I think compared to 2008, I think it's misunderstanding a little bit about 2008. The 2008 was a financial-driven crisis. I think a lot of our current problems are like real economy driven. That we've had, the COVID pandemic does have kind of long-term impacts on, I think on profitability, on kind of international trade. There's been a lot of weirdness there. That these are kind of lingering effects that I think can impact. Valuations were very high. And they really did some weird stuff between 2020 and 2022, right?
Right.
But the 2008 it was a lot of. It wasn't the same sort of kind of real economy shock that the last 3 years have been.
Right.
Yeah.
So the point of going through that exercise and kind of going over these charts and saying, well, if it does happen, we don't have control over whether stocks tank or not. But whenever we get down to a COVID low again, I'm sure we'll get to that again, or not necessarily. We'll get to a super panic situation. You got to be ready to look forward and say, well, how undervalued are the stocks? How reliable are the earnings? How does the current environment affect what I'm watching? And that's why we're doing this exercise with Qualcomm. When we see people on TV say this stock is half off now, we got to be willing to go and say, well, over time, how reliable is this earnings going to be? How, like, for instance, we look at Qualcomm, we say, well, it's not that reliable, so we can't really trust a stock like this, in a market drop, because, it'll probably, in a bad time, it'll probably not have great earnings. But if you see a stock, similar to Google that has a straight line up, every year, even the bad ones, that's a good indication that if it gets half off or 1/4, if it goes down to, a fraction of where it's trading at now, it'll resume its growth over time, right?
Mhm.
So that's the tricky part, and we got to be ready for anything, anything to happen, and we can't be affected by what the people say on TV, and we got to look at these numbers and see if it actually makes sense. Is this business model affected by recession? I mean, how long do recessions last? They last 6 months usually, right?
Yeah.
So I think most of the stocks we're following are typically quality earnings. People buy less during a recession. Let's look at some of the stocks just for kicks. In the stochastics of going over. Okay, let's go over to sectors just for fun. The S&P pretty much goes right along with the recession. If there's a recession, people buy less. The economy is slower, so that the earnings are less. So that's pretty consistent. And for technology, it's double that, because they're usually high growth, and if you take away liquidity, the QQQs are going to go down a lot more, because they borrow money to grow, and if they cost more to borrow money, they're not going to grow as much. And let's look at consumer discretionary. During recessions, people cut back. So, but they got to buy. Do they got to buy? Consumer discretionary means you don't have to buy it. You don't have to buy a new iPhone. So, I guess when people cut back in a recession, that's bad for this index. Materials. There's less materials being consumed when there's less business activity, so that's bad for this group. This is totally out of whack. I don't really know an answer to the communication sector, but health fund, I expect this to be stable throughout a recession, because people still need the health care regardless of price.
Yeah, I think there's kind of a long-term tick up in health needs as the population ages and stuff like that. I think that there's there are kind of secular trends there you have to think about. So.
Yeah, right. So that's great. Yeah, and I think the other trends are right. The population's growing older. Living longer. So the more you live, the more health care you need. So, okay, let's look at the consumer staples. These are things that people have to buy, good times and bad. So that's going to be stable in a recessionary environment. Industrial, of course, will go down with the economy. So as the economy contracts in a recession, the demand for industrial companies goes down. Financials. Now this is a little bit. I guess as there's a recession, usually as interest rates go up, that's good for the banks. They improve their net interest margin. It's surprising to me that I guess as consumers borrow more, they'll be charged a higher interest rate. That's better for the banks, but there's more consumer losses, so the banks have to set aside more money for losses and bankruptcies and things. They're not going to pay their bill on time, etc. So I'm surprised this isn't flat. I thought that this would be in a recessionary environment with interest rates going up. I thought that would be good for banks, but it isn't. So let's look at.
Trying to understand banks are very weird. I've never really. I think that each one can sometimes be a very different model. There's banks that some of the big investment banks that the partners get a lot of the money, or the executives. and that money doesn't go to the stock, doesn't go back into the stockholders. And then consumer-facing banks, I think, are very different. I think banking is very difficult I think you'd have to have kind of specialty and kind of really understand what you're buying.
Yeah, a guy named Louis Navigliere said he used to be a bank analyst, and he basically said you can twist the numbers whatever way you want, and report whatever way you want. No one will even know, and it's you really have to be a bank analyst to understand banks really, and they're a different sector than every other because they rely so much on borrowing money that you can't even look at their debt because it's like a totally different sector, and that's kind of like how Berkshire Hathaway is. It's treated like a financial, but no one understands it. So I guess it's outside of our realm, common people here, to really understand banks in general, but I guess we have to rely on at least the earnings estimates of analysts that do understand this. All right, so XLU, we would expect in a higher interest rate, and as interest rates go up, you would think in an unstable environment, people would flock to yields. But as yields go up, you would think that the demand for utility, like investments, go down because if there's a secure treasury yielding 5% and the unsecure utilities fund pays 4%, I would go for it with something that's more secure. And I think that could be what's happening in this as it broke out of this long-term, sideways pattern. Maybe this is a start of a new downtrend. If the rates go up more, there's less demand for utilities. I don't know.
Yeah, I think that's been for a long time. I think a lot of people were chasing yield, and some of like dividend stocks were being owned for that purpose. And as yields available elsewhere, I think that will have a short-term impact here on anything where it was like kind of people were owning it for the dividend.
Right.
And the utilities might be the prime example of that.
Right. So it's like before last year, it was like there is no alternative. So if you wanted a yield, you had to do something like REITs or like utilities, and there wasn't an alternative. Now there is. So I would expect that. I would just based on what we said there, I would expect the utilities to go down as the rates go up. But let's watch that just for fun. Real estate. The housing market with rising interest rates, there's a lesser demand for mortgages, and the whole real estate sector is at the mercy of the interest rates, it seems.
So this is going to be separate from like REITs, right?
Right. Well, REITs have their own issues.
Yeah.
Because
REITs are mostly commercial, right? They're not. Yeah. They're not mostly residential.
I guess for REITs in this environment, I think it wouldn't be that bad of a place for a yield because I guess there's a problem with REITs where they have mortgages, and then as mortgage rates go up, maybe they might have to.
I think REITs can also be affected because people go to them for the yield. I think a lot of people own the REITs for the yield, and if interest rates go up, I think the assets can go down.
Yeah, that could be it.
So I'm not sure. Intuitively, it seems like I think a lot of people went into REITs for the yield.
Right,
and
maybe
there might be trouble there.
Yeah, so we'll have to start following a REIT ETF just for that purpose. I think it'll be going down. Energy is this is surprising to me that if we're in a possible 70%, 80% chance of a recession, you would think that the price of oil is going down, but it continues to hit higher highs, higher lows. So right now it's at the top of its range. It'll probably go down to here.
I think energy also though had many years of kind of underperforming.
Oh yeah.
And so some of that might just be catch up of people start looking at it again and any movement at all is something to help it.
A lot of these stocks right now are very low PEs, like 6, a PE of 6, like ExxonMobil, and has a yield of like 5 or something. So you have these, I think, compared to the rest of the market, really a low PE ratio, you have a high dividend, and that works really good in this kind of environment. So maybe that's that's why this is continuing to do well.
Yeah, it had a really low base. Like the energy stocks have not done well for many years now. So I think that part of it is just it's working out such a low base of valuation.
Let's look at that just for fun. But if there is some kind of a turmoil overseas, like Saudi Arabia decides not to export or whatever it is, that affects the price of oil, and it's not necessarily. Look how this is energy sector over time. This goes back only 3-5 years. Okay, it's not that far, but yeah, it's relative underperformance. It hasn't gone anywhere in 5 years really.
You put the S&P on this, and the S&P will be way higher. Like it's just really been very miserable for energy.
Let's do that just for fun. So to compare the S&P. The S&P is in blue, so you can see it greatly outperformed the S&P than the energy. So yeah, it gets a reversion to the mean. We were talking about that remember in December of last year, we were saying at some point in time there's a reversion to the mean. And the S&P is trading at P of 28 back then, and it should revert to 14. And the same thing with the energy stocks. They were trading at a P of like 6, and now they're going towards their long-term average at 10 maybe or something like that. So I guess a good exercise every year is just to see, well, what's the mean? And that's why we do these charts with the Qualcomm, because what's the mean that people are usually paying for this stock? And right now the PE ratio is half of that. Maybe it is a bargain. But that's why for every stock we own, we have to follow, what is the mean? And because eventually things revert back to the mean. You got to be ready for that. So let me see. What else are we doing? Okay, so, all right, so let's look at, we already looked at Qualcomm. Okay. Okay, so I think last thing is today's earnings week. We had, I think I mentioned on our chat that this is the week where Apple, Amazon, Google report the earnings. There it is. Google, Visa, MasterCard, Apple. We know from Visa, we had a lot of news this week from the American Express, MasterCard. Consumers are still spending, and it's not like people are going to be holding back for the Christmas season. So that's really good for retail and for the economy. And we'll see what if the companies meet estimates or beat a little and they go down. That's a bad sign, because usually if they beat and they go up, that means the market is in like a good mood. But if the companies beat and they go down, that means we're probably going to go down to the next level in the S&P. And it's all based on the interest rates, I think. How the market interprets earnings reports. So this could help us in the next week, or it could hurt us. So we will see. And I think I've used all